Hello, everyone, and welcome back to the Commodities Institute podcast. I'm Emily Costa, and today is December 18th, 2025. As always, I'm glad you're spending part of your day with me, because the commodity markets right now are giving us one of those moments where everything feels connected. Energy, metals, agriculture, power, freight, geopolitics, and even social stability are all colliding in ways that will shape how the next few years unfold. Let me start by setting the tone. We are seeing a clear reassertion of old forces after years of experimentation. Energy security is back at the center of decision-making. Governments are recalibrating trade and supply chains. Investors are gravitating toward tangible assets again, and communities that depend on commodities are feeling both opportunity and strain at the same time. I want to begin today in oil, but not where you might expect. Instead of starting with prices, let's talk about leadership, because leadership choices often signal where capital and strategy are headed next. BP's decision to appoint Meg O'Neill as its next chief executive is more than a personnel change. It is a statement. For the first time in its more than 100-year history, BP has chosen a chief executive from outside the company, and notably the first woman to lead any of the world's top 5 oil majors. O'Neill comes with decades of experience at ExxonMobil and more recently at Woodside Energy, where she oversaw aggressive expansion in oil and gas and a major merger that doubled production. This tells us something important. BP is no longer hedging its identity. After a costly and uneven pivot toward renewables earlier in the decade, the company is now firmly recommitting to oil and gas profitability, asset discipline, and shareholder returns. Slashing renewable spending, selling $20 billion of assets by 2027, and focusing on natural gas all point to a broader industry trend. Capital is flowing back to hydrocarbons, not because the energy transition is over, but because companies are under pressure to fund it from profitable core businesses. That theme of pressure and power continues when we shift to Venezuela. Oil exports there have been thrown into fresh turmoil after cyber attacks disrupted state oil company systems and the United States escalated enforcement of sanctions. Even though loading has resumed at some terminals, most crude remains effectively stranded. Tankers are sitting offshore, some with tracking signals turned off, waiting in legal and logistical limbo. Roughly 15 million barrels are estimated to be stuck in Venezuelan waters. This matters far beyond Venezuela. When a country with the world's largest crude reserves cannot reliably export, global markets feel it. Prices moved higher almost immediately, even with broader supply still ample elsewhere. The situation also highlights the growing risks in maritime trade. Sanctions enforcement, cyber vulnerabilities, and military posturing are now just as important as geology when it comes to oil flows. From oil, I want to pivot briefly into agriculture, because food security is once again intersecting with conflict. Ukrainian grain exports have slowed sharply as Russian attacks on ports and infrastructure continue. Wheat terminals are operating at a fraction of capacity, power outages are constant, and traders are struggling to manage logistics. Ukraine exports roughly 70% of its wheat harvest, and any disruption ripples quickly into global food markets. At the same time, trade politics are complicating the picture. China has cancelled purchases of US white wheat, citing ample global supply and cheaper alternatives from Argentina. This cancellation is a reminder that even when geopolitics appear to stabilize, price competitiveness still rules agricultural trade. For US farmers, it adds pressure in an already oversupplied global wheat market, pushing futures prices to multi-month lows. Let's move now into metals, because this is where the emotional core of today's episode really sits. Gold has had a historic run, doubling in price over 2 years and posting its biggest annual gain since the 1979 oil crisis. Analysts are now openly discussing prices near $5,000 per ounce in 2026. That would have sounded unthinkable just a few years ago. Why is this happening? Part of the answer lies with central banks. For the 5th consecutive year, they are diversifying reserves away from the US dollar and into gold. This steady price-insensitive demand has created a powerful floor under the market. Add to that investor anxiety over fiscal deficits, geopolitical conflict, trade disputes, and concerns about central bank independence, and gold has transformed from a cyclical hedge into something closer to a structural portfolio anchor. What fascinates me most is the broadening of the buyer base. We now see corporate treasuries and even stablecoin issuers holding physical gold. That crossover between digital finance and ancient metal is symbolic of our times. It reflects a search for trust and permanence in a world that feels increasingly fragmented. But metals are not just about prices. They are also about people and places, and nowhere is that clearer than in Guinea. The Simandou iron ore project, long touted as a once-in-a-generation opportunity, has finally begun exporting. Yet, just as production ramps up, thousands of workers are being laid off. Employment peaked above 60,000 during construction, but fewer than 15,000 jobs will remain in the operational phase. This sudden demobilization is creating real risks. Communities that reorganize their lives around mining income now face uncertainty. There are concerns about social unrest, safety and accidents along new rail infrastructure. The government promises long-term transformation through its Simandou 2040 vision, but for many workers the future feels abstract and distant. This is the uncomfortable truth of mega projects. They can boost national output dramatically while leaving local inequality unresolved. Before we wrap up, I want to touch on power and carbon markets, because electricity is becoming the silent driver of commodity inflation. In the United States, capacity prices in the PJM grid have hit new records, rising roughly tenfold in just 2 years. The culprit is demand from data centers, especially those supporting artificial intelligence and cloud computing. Supply simply cannot keep up. For households, this translates directly into higher utility bills. Some regions have already seen increases of more than 20%. For power producers, it means windfall revenues. For policymakers, it presents a dilemma: how to encourage new generation fast enough without pricing consumers out of essential energy. Across the Atlantic, Europe is making a different kind of energy decision. The European Parliament has approved plans to phase out Russian gas imports entirely by late 2027. Pipeline gas will go first, followed by liquefied natural gas. This is a historic shift for a continent that once rid on Russia for nearly half its gas supply. It underscores how deeply energy policy has become intertwined with security and values, not just cost. When I step back and look at all of this together, a few themes stand out. Commodities are no longer just inputs, they are strategic assets. Leadership decisions at oil majors, sanctions on tankers, attacks on ports, gold buying by central banks, layoffs at mines, and soaring power prices all tell the same story. The world is repricing security, reliability, and resilience. As investors, producers, and consumers, we are navigating a landscape where volatility is not an anomaly, but a feature. Understanding the connections between these markets has never been more important. That's where I'll leave it for today. Thank you for listening to the Commodities Institute podcast. If you found this episode valuable, be sure to subscribe, share, and leave a review. I'm Emily Costa, and I'll see you next time.